Can doing nothing be a strategy? A behavioral finance and strategic decision-making analysis. At first glance, doing nothing sounds like passivity. In investing culture, activity is often equated with intelligence. But research and long-term performance evidence suggests something different. In certain contexts, strategic inaction can be a powerful and rational strategy. The key distinction is this: doing nothing by default is negligence. Doing nothing by design is discipline. 1. The cost of action bias. Humans have a strong tendency toward action bias, the impulse to act in uncertain situations. We feel more in control when we move, more responsible when we respond, more productive when we adjust. But action bias can reduce performance. Research by Brad Barber and Terence O'Dean shows that higher trading frequency is often associated with lower net returns. In many cases, reacting frequently creates friction, transaction costs, tax drag, timing mistakes, emotional errors. Doing nothing avoids these frictions. 2. Compounding requires stability. Compounding is fragile. It depends on time, continuity, low interruption. Frequent intervention resets positions and shortens holding periods. Investors influenced by Warren Buffett emphasize that long-term wealth is built through patience, not constant optimization. Sometimes, the optimal move is simply to stay invested. 3. Myopic loss aversion and overreaction. Behavioral economists Shlomo Benartzi and Richard Thaler demonstrated that frequent evaluation increases perceived losses. More monitoring, more emotional discomfort, more action. If short-term volatility is noise rather than signal, inaction becomes rational risk management. Reducing reaction frequency can improve long-term outcomes. 4. Strategic inaction versus passive avoidance. Doing nothing is a strategy only if you have a defined long-term thesis. Asset allocation is intentional. Risk exposure matches your capacity. Rebalancing rules exist. Strategic inaction means I am not acting because the plan does not require action. Passive avoidance means I am not acting because I am disengaged. The difference is awareness. 5. Optionality and patience. Sometimes doing nothing preserves optionality. When uncertainty is high, acting prematurely may reduce flexibility. Waiting allows more information to emerge. Strategic patience keeps capital available for asymmetric opportunities. Time can clarify what volatility obscures. 6. Emotional regulation as a competitive advantage. Psychologist Daniel Kahneman showed that humans experience losses more intensely than gains. Volatility triggers fear and urgency. Choosing not to react requires emotional control, identity stability, trust in process. In this sense, doing nothing can be psychologically demanding, not lazy. 7. When doing nothing is not a strategy. Inaction is harmful when fundamentals deteriorate permanently. Risk exposure becomes misaligned. Allocation drifts excessively. Structural mistakes go uncorrected. Strategy requires periodic evaluation. Inaction between evaluations can be optimal. Inaction forever is not. 8. The paradox of intelligent inactivity. Markets often reward endurance, low turnover, emotional stability, more than constant prediction. In many long-term frameworks, the investor who reacts least often compounds most. The core insight: doing nothing is not automatically a strategy, but when grounded in clear structure, long-term thinking, defined rules, emotional discipline, it can become one of the most powerful strategies available. In investing, sometimes the hardest action is deliberate inaction, and sometimes doing nothing is exactly what the strategy requires.